An asteroid worth $10 quintillion sits in deep space, yet every single high-tech company that tried to mine it ended up totally bankrupt. Floating in the cold void between Mars and Jupiter lies 16 Psyche, a celestial mountain packed with pure nickel, iron, and gold. On paper, there is enough raw wealth locked inside this single space rock to turn every living human being into an instant multi-billionaire. For decades, this staggering figure existed purely as an astrophysics fun fact. But around the year 2012, a group of high-profile Silicon Valley billionaires looked at that price tag and decided it was time to stop theorizing and start digging. They proclaimed that humanity was about to open its greatest economic frontier, the era of commercial space mining. The pitch was intoxicating. Silicon Valley had spent the previous decade generating fortunes off software code and social media platforms, but space mining offered something infinitely larger, building the world's first trillion-dollar enterprises while solving Earth's resource depletion. Terrestrial mining is dirty, destructive, and deeply controversial. Digging for rare industrial metals destroys rainforests, poisons local water tables, and relies on volatile global supply chains. Space mining promised the ultimate green alternative. Take the heavy industry off our fragile blue marble and move it into the vacuum of space, harvesting lifeless rocks floating harmlessly through the solar system. Two flagship startups immediately stepped into the spotlight: Planetary Resources and Deep Space Industries. Planetary Resources launched with an all-star lineup of investors, including Google executives Larry Page and Eric Schmidt, filmmaker James Cameron, and space entrepreneur Peter Diamandis. Shortly after, Deep Space Industries entered the race with glossy, cinematic concept videos showing autonomous spacecraft using high-powered lasers to slice through metallic asteroids. News headlines across the globe proclaimed that the world's first trillionaire would not be made in real estate or software, but in deep space. These early pioneers pitched a simple three-step strategy to investors. Step 1. Launch low-cost prospecting satellites to scan passing near-Earth asteroids for high-value metal reserves. Step 2. Deploy automated mining craft capable of locking onto a target rock and extracting the raw ore. Step 3. Transport those refined precious metals back to Earth's orbit or drop them directly through the atmosphere to sell on global commodity markets. To venture capitalists accustomed to funding software apps, it looked like a logical engineering challenge with an astronomical financial return. Capital poured in, headquarters were established, and top-tier aerospace engineers were hired to build satellite prototypes. The industry brimmed with Silicon Valley optimism. These were agile innovators intent on disrupting space exploration the same way modern tech firms disrupted traditional retail and transportation. They genuinely believed that within a decade, robotic spacecraft would routinely harvest space metal, unlocking limitless prosperity. However, as engineers transitioned from slide decks to physical hardware, the brutal realities of space exploration hit home. Every single bolt, thruster, and sensor had to be custom engineered to endure extreme solar radiation, vacuum conditions, and radical temperature swings. Launching heavy hardware off Earth required vast amounts of rocket fuel to escape Earth's gravity well, costing up to $20,000 per kilogram. Building a full-scale deep space mining fleet capable of capturing multi-ton asteroids required hundreds of billions of dollars in upfront capital long before retrieving a single gram of ore. Worse still, the early space miners had overlooked basic commodity economics. The premise of hauling metals like platinum back to Earth to make billions contained a self-defeating flaw. Platinum commands a high market price precisely because global production is low, totaling roughly 200 tons per year. If a space mining company successfully captured an asteroid and delivered 20 tons of pure platinum back to Earth, global supply would jump by 10% overnight. That sudden influx would trigger market panic, causing commodity prices to crash by 30 to 50%. The very asset the company spent billions to retrieve would suffer a massive drop in market value, wiping out projected profit margins. When factoring in the astronomical cost of deep space fuel, thermal shields for violent re-entry, and environmental liability insurance, hauling raw industrial metals back to Earth was not a gold mine. It was a guaranteed path to financial ruin. Realizing that bringing heavy metals back to Earth was an economic suicide mission, executive boardrooms panicked. They needed a new narrative for investors, prompting a dramatic corporate pivot around 2015. They abandoned the dream of hauling gold and platinum back to terrestrial markets and announced a new primary target: in-space resource utilization. Their primary target was no longer precious metal, but something far more ordinary: water. To an average viewer, mining water in space sounds bizarre. Water covers over 70% of Earth, and you can buy a bottle for $1. But in deep space logistics, water is liquid gold because it weighs 1 metric ton per cubic meter. Dragging heavy water tanks off Earth consumes immense amounts of rocket propellant. However, extracting water ice directly from carbonaceous asteroids or shadowed lunar craters changes everything. Through electrolysis powered by solar energy, water molecules split into hydrogen and oxygen, yielding raw rocket propellant and breathable air. Imagine building a luxury electric vehicle charging station in the middle of the Sahara Desert in the year 1905, decades before mass-market automobiles or paved highways existed, hoping that building the station would magically create the drivers. That was precisely the space mining industry's new business model: becoming orbital gas stations. They argued that interplanetary probes, military satellites, and future spacecraft could launch nearly empty, fly to an orbital depot, and refuel with asteroid-derived propellant at $20,000 per liter. Yet, this pitch hid a fatal flaw: the customer base simply did not exist. To run a profitable station, you need steady traffic. In the 2010s, and even today, there were no commercial fleets, moon shuttles, or interplanetary transports pulling up to buy fuel. The industry was spending fortunes building a complex supply chain for an entirely theoretical customer base, hoping demand would spontaneously materialize. Even if customers existed, physical operations on an asteroid made science fiction look simple. Asteroids are not solid, stable islands floating peacefully in space. Most near-Earth asteroids are rubble piles, loose agglomerations of gravel, boulders, and dust held together by microgravity so weak that an astronaut jumping off the surface would float away forever. Standard terrestrial techniques like heavy drilling or mechanical scooping are useless on a floating dust pile. Trying to drill into a rubble pile asteroid in zero gravity is like trying to drive a screw into a floating cloud of dry flour. Because every action creates an equal and opposite reaction. Pushing a drill bit into the rock without anchoring causes the spacecraft itself to spin wildly in the opposite direction. Anchoring into loose gravel is virtually impossible, and the moment a mechanical tool touches the surface, razor-sharp, static-charged dust explodes into the vacuum, coating camera lenses, clogging joints, and destroying solar panels. Furthermore, immense orbital distances created crippling communication delays. Radio signals traveling from Earth control centers to a deep space asteroid take anywhere from 3 to 15 minutes one way. You cannot maneuver a robotic drill arm with a joystick when every command takes 15 minutes to arrive and another 15 minutes for the video feed to return. Every aspect of extraction had to be fully autonomous, managed by onboard software capable of handling real-time mechanical failures in deep space. In the 2010s, autonomous robotics and edge computing processors were nowhere near sophisticated enough to manage these unpredictable environments. Startups were promising levels of artificial intelligence that were decades ahead of engineering reality. Layered on top of these technical and economic hurdles was a legal nightmare that terrified conservative investors. International space law was anchored by the 1967 Outer Space Treaty, which stated that no nation could claim sovereignty over celestial bodies. While this prevented Cold War weaponization, it left private companies in a legal vacuum. Imagine spending $500 million to extract valuable resource deposits from an asteroid, only for a rival company to land right next to your rig and take the mined ore for themselves. Who actually owns the property, and what court enforces that claim? To address this, the United States passed the Commercial Space Launch Competitiveness Act in 2015, granting citizens rights to extracted space resources. Other nations like Luxembourg passed similar laws to attract space ventures. However, global consensus remained murky, and legal scholars debated whether private resource ownership violated international treaties. For institutional investors seeking low risk, deep space mining looked like an unregulated Wild West. By 2018, the financial clock ran out. Venture capital funds operate on strict 5 to 7 year return windows. As year after year passed without a single gram of asteroid ore delivered, investor patience evaporated. Capital dried up, and high burn rates crushed corporate balance sheets. Slick CGI videos could no longer disguise the core reality. Space mining startups were burning millions with zero incoming revenue. The collapse was swift. Planetary Resources ran out of cash after failing to secure vital funding and was liquidated in late 2018, its assets acquired by a blockchain software firm named ConsenSys. The engineering teams scattered, and satellite designs were shelved. In early 2019, Deep Space Industries met a similar fate, bought out by Bradford Space to build conventional satellite parts. The multi-trillion-dollar dream dissolved into quiet liquidation sales and asset write-offs. The early space miners committed a classic tech bubble error, confusing raw scientific possibility with market readiness. They tried to build a 22nd century industrial economy using fragile rocket architecture and short-term venture capital timelines from the 21st century. Yet the concept of space resource extraction did not die. It evolved into a pragmatic second act. Today, the foundation is being reshaped by massive shifts in launch infrastructure. SpaceX's Super Heavy Starship system is altering launch economics by offering reusable orbital capacity that lowers the cost per kilogram, removing the financial wall that suffocated early startups. Furthermore, space agencies have pivoted toward a far more logical starting point: the Moon. Under NASA's Artemis program, government agencies and private contractors are targeting water ice trapped in permanently shadowed craters at the lunar South Pole. The Moon is 3 days away rather than years, signal delays are 2 seconds rather than 15 minutes, and surface gravity provides a stable environment for heavy machinery. The objective is no longer quick wealth from cosmic platinum, but building refueling infrastructure for long-term exploration. The true value of space resources will never be hauled down to Earth to be traded on commodity exchanges. The real wealth lies in building a self-sustaining off-world economy where ships, propellant, and habitats are manufactured in space using materials gathered across the solar system. The truth about space mining companies is that they were not wrong about the potential of celestial resources. They were simply 30 years too early. They didn't find gold in the stars, but they left behind a multi-billion-dollar lesson written in cosmic dust.